Divergence detected. The 30-year yield just matched its highest close since June of 2007, while the dollar quietly slid toward a 2-month low. That pair almost never prints together. And today, it mapped straight into the scan's #1 picks. We end on the ETF and the stock the engine surfaced, and one of them already caught the move. SPX stalled right at weekly resistance, slipping about 0.5%. And the weekly chart is flagging a potential reversal pattern. QQQ absorbed an intraday gap and trap while the VIX started to lift, with breadth lagging the headline and junk bonds flashing a bearish divergence underneath. But the COT data cuts the other way. Large speculators are piling into shorts, and historically, that has been the setup for a squeeze back toward the highs. Cracks below, squeeze fuel above, and which side wins likely comes down to the dollar. What the dollar did today is the strange part. The dollar index is pressing its lowest levels in 2 months, with September rate hike odds compressed to around 30%, and that alone is telling. But the 30-year Treasury yield is sitting at 5.31%, its highest close since before the financial crisis. Even as the dollar weakens, and TLT keeps grinding lower, a weakening dollar alongside a rising long end is structurally unusual, and the back end clocked it immediately. With U.S. interest costs already running at 20% of tax revenues, the long end move gets very hard to dismiss. And that same pressure is leaking straight into the energy market. Brent is holding firm on Hormuz risk and an expiring Iran ceasefire, and crack spreads keep printing higher highs. But here is what the system actually flagged. Diesel is dramatically outperforming WTI, which sits materially lower, and that split is unusual for the energy complex. XLE is pressing toward resistance with a flag pattern developing, potential upside still unconfirmed. USO is consolidating below its spring highs, and the Strategic Petroleum Reserve sits at its lowest level since the early 1980s. That is structural supply pressure, not a one-session anomaly, and it is the same pressure putting a floor under the metals bid. Gold keeps posting higher highs and higher lows. GLD is holding structure near the top of its range, and the miners are leading the move, which is a classically bullish setup for precious metals. Silver is eyeing its resistance zone, and the system reads dollar softness plus fading hike odds as the primary driver of the bid. There is one fault line. Copper staged a sharp late-week sell-off the precious side has not accounted for. The industrial and precious signals are pointing different directions. Underneath it all, foreign central banks keep rotating reserves into gold instead of treasuries, and that same rotation shows up in the international data next. Japan, Taiwan, and Korea are each flagging a different risk. EWJ faces Japan, CPI data, and the Fed minutes this week, while EWT and the KOSPI have both flagged whipsaw risk into those catalysts. The EAFE index is trading at nearly 19 times earnings, above its 5-year range, stretched, and sitting right on top of a heavy macro week. EEM caught a bid on the weekend's tentative tariff deal, but broad China follow-through still has not shown up. The edges of the international picture are defensive, which makes crypto's compression right now even more notable. Bitcoin is consolidating inside a descending channel, and the Bollinger Bands have compressed. The system is flagging an imminent directional move. It just cannot call the direction yet. A nearly $400 million weekly outflow from the Bitcoin ETFs, IBIT included, plus the Clarity Act vote getting pushed back, keeps the setup firmly defensive. This second bear market leg has taken Bitcoin down roughly 30%, and a bullish RSI divergence at the lows is driving the current bounce. But the longer-term structure still points lower. Compression this tight resolves violently, and Bitcoin sitting unresolved right here is what makes the scan's ranking output so interesting from this point forward. That dollar yield split from the open, yields climbing while the dollar fades, is exactly what put rate-sensitive assets in play today. SignalFinder Pro ingested 147 symbols for today's ranking, and the engine scores durable structural leadership, not whoever just closed green, which makes today's output genuinely counterintuitive. The top of the sector list finished the session red across the board, and the #1 ETF still caught the day's relief bid anyway. The sectors frame the context. The ETF and stock reveals are right after. The scan's top 3 sectors, healthcare, XLV, financials, XLF, and industrials, XLI. All 3 ended the session in the red, and all 3 sit in a lagging signal state. That sounds bearish, but it is actually how the ranking engine identifies longer-term underlying strength, independent of short-term price action. Healthcare at number 1 lines up exactly with where the ETF scan is pointing. The counterintuitive read. The engine is not rewarding today's winners. It is surfacing the setups the daily tape does not make obvious. And the number 1 ETF is the cleanest example of that. The number 1 ETF in today's SignalFinder Pro Best of Best scan. ARKG, the ARK Genomic Revolution Fund, a high beta basket of genomics and biotech names. Here is the payoff. On a day the top sectors closed red, ARKG finished green, up over 1%. Long duration growth catching exactly the relief bid that a fading dollar and compressed hike odds are supposed to deliver. That is the dollar yield split from the cold open, showing up in the number 1 slot the same session. The signal state is still wait. The structure is there. The live trigger has not fired. Structure first, trigger second. That is the discipline. The number 1 stock, QLYS, QLYS. It is a cybersecurity name that closed down about 1.5%, and the ranking engine still put it on top, reading through to longer-term leadership, not following the intraday move. Cybersecurity tends to hold its underlying bid through broader market pressure, and QLYS at number 1 on a down day is the engine surfacing exactly that kind of setup. The signal state is watch, flagged at the top of the structural read, not yet fully triggered. 2 number 1s, 2 different messages, and 1 split that ties them together. The 30-year matching a 19-year high, while the dollar fades. That split turned out to be the rate sensitivity signal of the session, and it landed exactly where the scan said to look. ARKG, a long-duration growth fund, closing green on a red tape, with QLYS holding the stock slot through a red session. The thing to watch tomorrow, does the 30-year hold up there or reject? Because that answer tells you whether today's relief bid in rate-sensitive names gets any follow-through. Verify both signals live in SignalFinder Pro before drawing conclusions from today's scan. And remember, this is educational content, not financial advice, so do your own homework.